All right, Kristof, this is exciting.
Absolutely. Good to see you, Bilal.
Good to see you. So today's guest is Kristof Gleich, who is the president and CIO of Harbor Capital, a $65 billion asset manager. And I'm excited to have you. How you doing today?
I'm amazing. All the better for seeing you. Really good to see you.
Oh, so you mean it's me?
Exactly.
It's me. I love it.
Exactly.
So, Kristof, I really appreciate you coming. This is important to me. I spent some time at Harbor in my career. I love the organization. I love the firm. But more importantly, you are a leader that is very intentional. So how do you feel about the market today, the position of the organization, and just your overall views?
Sure. So look, there's, I think change is the theme. Our industry is in a state of flux. And, you know, I've been at Harbor now for just over 7 years. And when I joined Harbor, we were a mutual fund firm, actively managed mutual fund firm. So just let me back up for 1 second. What does Harbor Capital do? We are an active manager, and we work with boutique fund managers from around the world that specialize in one or two things that they do very well. And we partner with them, and then we bring them to the US marketplace. And historically, we've done that in mutual funds because that was the way your everyday investor gained access to the markets, through actively managed mutual funds. The industry's changed a lot, and so we've had to adapt and evolve with it. And so for us, that meant really leaning into active ETFs about 4 years ago. So we've been in the market a little under 4 years. It's really exciting, learning lots. You know, it's great to be here at the NYSE, the home of the active ETF and this beautiful library. And so, yeah, we've had a lot of fun standing up our active ETF platform. We're hitting some good milestones at the moment. Specifically around markets, it's a very different in market environment today. I like to sort of think long term. I like to think in decades. And as I sort of characterize the different decades, I think the 2020s looks very different from the 2010s or 2000s or 1990s. And I think this is absolutely an environment where you want to be selective, you want to be curated, you want to be active. And so we feel really well positioned from that perspective.
I love that. So given your seat as a CIO, right, you've been in this role for over 4 years now. How do you feel like your role has changed? It seems like, you know, historically the CIO would be the one that sets the strategic investment decisions, right? And how we look at the world. I feel like now your role might be a little more hands-on and more involved with some of the investment decision making.
Yes, so I've spent 25 years in markets, and my secret sauce it has been just an ability and sort of through 3 years of learning and putting in processes and systems of how to sort of identify true alpha and true outperformance. And so I love getting involved and help setting the agenda of where do we want to launch different ETFs or different products? Where do we think we can compete? Where do we think we can really add value for our clients? Because ultimately, if we can't add value for our clients, then what are we doing? And so I do work very closely with the research team. I have a phenomenal sort of manager research team. I have a phenomenal multi-asset team, and we have an awesome product team, and it's kind of working together. Maybe I conduct it as kind of as an orchestra, sort of a conductor. For sure. It might be a good analogy. But I love it. It's the lifeblood. It's what I get out of bed for in the mornings. It's really exciting.
I love it. I love it. So given your role, given your seat, you're working closely with research. How do you feel about the landscape we're in today? Obviously, the first half of the year was no shortage of headlines and/or activity, extremely high trading volume. How do you feel about where we are, and what are you excited about?
So in terms of the overall backdrop and sort of growth outlook, it's pretty good. So we invest from a multi-asset perspective around the business cycle and where we think we are, and then we map out different phases of the business cycle. And where we are at the moment is late cycle expansion. And what does that mean? It means it's typically pretty good for risk assets. And you're seeing that in markets. You know, markets are trading at, or depending on the day and when this goes out, at around all-time highs. clearly the markets had a huge shock in around the tariffs. There was a lot to digest. But as we've seen, as you've seen over your career, selling risk assets when they are down, 15, 20% in such a short space of time, it feels like emotionally gratifying doing it in the moment, but it's normally financially devastating, unfortunately. And we've seen that's happened yet again. And, if you look at flows this year, it's quite sad when you think about it, because flows have been positive January, February into March, and then they collapse, and there was a massive outflows in April. And it's just, you see it and you're like, you're getting out of the market at the wrong time. It's critical to have a long-term investment plan and stick to it. And now they've since recovered, and you're beginning to see sort of net flows and money come back in again. So I think, valuations are a little rich. It's hard to make a valuation only argument here, certainly here in the US. But there is still so much growth happening around the AI theme. And if you look at the capex of, effectively the Magnificent Seven, or the subset of the Magnificent Seven that are really driving this, there's an arms race that they need to win. And you sort of see that trickle throughout the economy and throughout the market. And so that's a theme that I think is really interesting and is, set to continue. Other things that we've been doing this year, diversifying. I think every client in the world probably to some degree has a home country bias. You could argue in the US, it's the only place in the world that actually makes sense to have a home country bias. But I still, when we see portfolios, and we do a lot of like model portfolio reviews, when you start to see 70, 80% of the portfolios in the US, as a risk. And then when we explain around the index concentration risk on top of that, I think your average investor has exposure to a smaller subset of companies than they perhaps realize. So we've been advising on diversification. That's diversification outside of equities and bonds, specifically commodities. And then we've been talking about diversification outside of the US as well. And I think unlike the US, you can make a pretty compelling valuation argument for international investing, whether that's international including or excluding emerging markets. It doesn't really matter. And I think what you're beginning to see now, and as a European, I'm quite happy about this, like Europe's waking up. Europe's been this sort of sleeping bureaucratic giant for, decades, 20, 30 years, some might even argue longer. And I think through, shall we say, less orthodox policy here in the US, one of the positive aspects or spillover effects of that is, I think people are realizing they kind of need to stand up themselves. And that has meant a lot of structural reform has happened in Europe very, very quickly. And that opens up different investment opportunities as well.
Yeah, I want you to stay with this global theme for a second, because you talked about diversification, and everyone's got home country bias in the US, obviously the largest dominant market. However, you could have been invested across the emerging markets as well as in different parts of Europe front part of this year, and did fairly well. How are you positioning clients in that particular backdrop? Meaning, how are you helping them to diversify? Are you pulling away from their large cap US equity exposure and then saying, hey, here's a solution? How are you addressing that particular need for the client?
So we're at the moment, we're depending on, obviously for all of your listeners and viewers, it depends on the individual client risk and tolerances, but we are overweight in international equities at the moment. We do that with active management. I don't think Europe is an area where you necessarily want to own the index. There are big parts of that index that, we don't think are going to grow. And there are parts of that index and specific companies. So I'll give you an example if I can. We have an ETF called the International Compounders ETF. It's with a boutique firm out of Copenhagen called Sea Worldwide. And all they do is try and find the best 30 companies overseas. to invest with, including some EM. So we leave them the discretion to do that kind of the relative trade-offs between whether it's developed in Asia or Europe or in India. And so that's how we think clients should sort of get their exposure overseas at the moment.
Have you been overweight? Have you been overweight international all year? Or
We
was
have.
this a new theme?
No, we came in actually. We made the switch. I think it was in Q4. I'm getting October, November time. But it was off the back of just the valuation, dislocations. And then I think, the US markets had run so far ahead of themselves.
Mm-hmm.
Yeah, there was uncertainty about the incoming administration. And I think we had some concerns about the dollar as well. And look, we don't have a crystal ball. We don't call things, perfectly. But I think when you come back to it from 101 investment principles of, diversification, being able to weather, different outcomes. Look, it doesn't matter how good an investor you are. If you're Stan Druckenmiller, or Warren Buffett, like you don't have a crystal ball, but you can intelligently ahead of time tilt your portfolio to make sure that it is insulated and going to be able to weather the unexpected. And that's really sort of how we think about things, where are we in the business cycle? What are valuations doing? What is sentiment doing? Or where is sentiment, I should say? And that led us to sort of tilt away actually out of small cap. And so that's been an interesting one because that's been an asset class where I think a lot of small cap specialists, I've never heard a PM, bearish on their own asset class. Actually, I've heard one guy from BlackRock, but that's a story for another day. But generally, PMs talk their own books, right?
Yeah,
that's
of course.
what kind of happens.
There's always a reason.
Yeah, there's always a reason. And look, what we would argue is actually owning small cap on average, like the sort of small cap index isn't a great investment. And so we've been underweight small caps. Now we've been playing certain areas of small caps, which I can kind of go into. But having more in international and actually still, despite the run up of, large growth, the reason that large growth has had such a terrific run is because that's where the earnings have been. That's where the earnings growth has been. And by the way, that's what we still think. So we do have a good allocation to large growth. I would say we're underweight small cap, we're overweight international, and we are overweight commodities and underweight fixed income a bit as well.
So let's pull forward the commodities conversation. I think that's very timely,
Yeah.
right? Especially given the fact that part of your perspective going into the year was that we'd have a weaker dollar, which we have had. And that's obviously been a tailwind for the European equities.
Yep.
There's also been a tailwind for gold and commodity prices.
Yes.
Could you expand on your views there?
Yeah, so we launched a commodities ETF. The ticker's Hedger, HGER, as in a hedge for your portfolio. And we launched this about 3.5 years ago. I think it was February 2022. And the view then, and this is, I think, important context, and I'll sort of juxtapose that with how we're thinking about it today. The view then was that the 2020s may prove to be a decade where commodities do well. And if you look back over the last couple of decades, the 1990s, I think was okay. The 2000s was a stellar decade for commodities. The 2010s was terrible and nobody owned it. Everybody hated it. And we had a view that actually commodities were going to play a role of diversification.
Okay.
And really this was sort of, we were worried about the end of this sort of 40-year bull market in bonds. And if you look at what bonds have done in a 60-40 portfolio, by the way, a 60-40 portfolio has been like the greatest invention ever.
Absolutely.
And if you look at how it's done,
Yeah.
in the 2010s, a 60-40 did 10% per year in a 2% inflationary environment. That's an 8% per year real return just for owning the market. Well, what's not to love? Layer in, you could basically do that for free. The nuance is the but is there was no inflation in that environment. There was no threat of inflation. In fact, there was if I can speak, there was a threat of deflation. And so every time there was kind of a risk-off event, it would be because there was some concerns about growth. So equities come down, and because of the concerns about growth, bonds rally. If the slowdown risk is being caused by inflation or inflationary concerns, something very different happens. Equities go down because generally, it's certainly in the short run, and negative inflation shocks are not good for equities.
Sure.
But what happens to bonds is they also go down in value. And so this decade, you've seen a reversal of what we've probably spent our collective careers saying and seeing and practicing, is that when equities zig, bonds zag, but now they both seem to zig and zag together.
Yeah.
And so we wanted to launch a commodities solution that would help portfolios diversify. So that's what we did.
Yeah.
And, so far so good. Where are we today? That was a long sort of context setting, but where are we today? Look, I think the tariff trauma or tariff tantrum is largely behind us. We're now left with an administration that is going to be focused on a few different D's, deregulation. This administration wants to get nominal growth higher. This administration is taking a big bet, whichever way, it doesn't matter which way,
to grow out of the debt problem.
To grow out of the debt problem. And you can get out of a debt problem by, cutting your expenditure and, controlling your expenses, or you can try and get out of a debt problem by growing your revenues or growing your sales.
Absolutely.
It is pretty obvious that this administration is now pinning themselves to the mast of growing their way out. So what do you need to do that, right? Deregulation is one thing. The other thing, the other D would be deficits. There is kind of disregard for deficit discipline. God, that is a lot of D's, right? And you've seen with the one big beautiful bill that's just recently been announced, we are going to be running now at steady state deficits of 6 to 7% in an economy that is growing. I have no idea how long that can carry on before the music stops. But right now, that's what's happening. And if you look at the impulse from the, one big beautiful bill over the next 1 to 2 years and out, it is expansionary.
Yeah.
So you're going to have, fiscal support is going to be, good for growth as well.
Sure.
And then the last D stands for dove. You're going to have a dovish Fed chair.
Turn it back on.
Chairman Powell I believe his term is up next May. There is a lot of talk at time of recording around appointing a new Fed chair earlier than would be tradition. If there's one thing that I can say with almost certainty is whatever this administration does, it will not be traditional.
Absolutely.
And so could I see an appointment sooner rather than later? Yes. What is the one prerequisite that any candidate needs to have to even be considered for this job? It's that they're going to be dovish. And so I think we're going to end up in actually quite an interesting situation that we've probably never faced before in the next few months, that you could have sort of Fed policy, like real Fed monetary policy, and then sort of shadow Fed monetary policy. I don't think that's a good thing, but it's worth thinking through that. And in whatever happens, I think the person who comes in to take over the Fed, you're going to have a much more dovish Fed chair. So if you look at sort of, deglobalization is going to continue. If you look at all the infrastructure spend that is going to be needed, supply chain security, I think all of these things really do set up a very bullish backdrop. We're not even talking about
equities.
For commodities. For commodities. And I think, whether it's, if you look beneath the surface, within commodities, gold continues to kind of hit new records. And it's doing it for a good reason. De-dollarization is going to be continue to drive gold. I think a lot of the buyers of gold now are just price insensitive. It's, they're trying to diversify their reserve asset bases. And it doesn't really matter if gold is like 3,500 or 3,700 or 3,400. They just don't want to have such a concentration in dollars.
For sure.
And that trend really began to accelerate with the Russian invasion of the Ukraine, and with the seizing of the dollar-denominated Russian assets. And I think that put the fear into the life of a lot of countries. And so that's going to continue as well. So I really think with this backdrop for the next few years, I think commodities, if you've got the right strategy and if you can allocate between the different subset of commodities, I think they're going to do really well and play a valuable part of client portfolios. And that's certainly the way that we're advising to be positioned at the moment.
I love that. So just if you can unpack this a little further, what is it that you do differently in commodities that sets you apart from just buying gold?
So going back to what I said earlier, we work with boutique specialists, money managers. And so we've partnered for our commodities ETF. It's run by a commodity specialist, right? So this isn't one of like 100 portfolio managers that work in an organization that happen to cover commodities. This is someone who lives and breathes the asset class each and every day. The firm that they run is called Quantix, Quantix LLC. And they run about 3.5 billion of AUM. They run hedge fund money, and they run long only money, and we're their kind of long only partner. The pedigree of the team is that the team used to help run Goldman Sachs's commodities trading division. And then they all retired and then reformed to start Quantix. And that's the largest risk book of commodities risk book in the world. And they were doing that for, depending on the individual, somewhere between 20 to 27 years each. So they come with this know-how, they come with this pedigree, and they come with a vision that they want to build at their firm that they're implementing inside our ETFs. So we think it's a way of getting like hedge fund quality money management in an ETF vehicle. And specifically how our ETF works and how it navigates is it's much more dynamic in its allocation between commodities. So it's rules-based. So we got them to create an index. That's another theme. I think the lines between active investing and index investing are blurring. We can no longer say index is passive and everything else is active, because I think a large subset now of index is really active.
Absolutely.
And this is an example of that. And so it dynamically allocates depending upon a couple of things, something called backwardation versus contango. And without making this super dry and boring, basically backwardation is good. It means you're being paid positive carry to own the commodities. Contango is bad. It means you're paying effectively carry away to own those commodities. So if you can position around that dynamic, if you can look at which commodities do well in inflationary environments, and you can identify what type of inflation environment we're in. Are we in an inflation environment that's driven by too few commodities or too much money, debasement versus scarcity? And you combine all those things thoughtfully, that's what makes it different. And so we compare ourselves to BCOM, the Bloomberg Commodities Index. It's kind of like the S&P 500 for commodities. For sure. And we've outperformed by about north of 700 basis points per annum since we launched the solution a few years ago.
I love it. Thank you.
Thank you.
So let's switch gears a little bit. We covered equities, covered global equities. We covered commodities. Let's touch on, because you brought this up earlier, the AI revolution and what you're seeing in the Mag 7 and obviously what's going on in big tech, because there's a lot going on in big tech.
Sure. So look, you saw a massive correction. I'd probably argue an overdue correction earlier this year. Yeah. There's certain ETFs out there run by competitors that track, just the Magnificent Seven, the Round Hill Fund, and that had a very, very sharp drawdown. we had the scare. Oh my goodness, I'm blanking on the name. The DeepSeek. I've got my marbles back. The DeepSeek scare. And I think that shook a lot of tourists out of the theme and out of the asset class.
Tourists.
Yeah.
Tourists. We call the investor a tourist.
Yes.
I like it.
And I have to give Mohammed Al-Irian of PIMCO credit to that one.
That's a good one.
When he described EM holders as the EM tourists and the residents. So that shook a lot of tourists out. But look, I think when you come down to it, the fundamentals are still there.
Yep.
The cash flow generation of, large growth. These are still some of the most profitable companies that we've, ever seen.
Yep.
The trick is going to be over the next 5 years. And what we're going to need to see is a translation of CapEx into cash flow. And at the moment, the market is giving them the benefit of the doubt, probably rightly, because of some of the experiences and success they've had reinventing themselves, and cloud and SaaS and going to mobile. And this is another key inflection point for them. So it's still an area of the market that we like. We still think the fundamentals are strong. We still think it should make up an appropriate amount of a portfolio. And it's a space that we're obviously going to be watching very, very closely over the next sort of 18 to 24 months.
Yeah, there seems to be a lot going on there. Let's switch gears now to fixed income, because you talked about obviously diversifying away from fixed income, but what does the world look like now, just given where we are? Obviously, we talked about debt. We talked about possible incoming new Fed chair. What are you seeing there?
So I think we've grown up in our careers. The role of bonds has been to provide, generate some income and provide some protection.
That's it.
Right. But you get the growth elsewhere, your equities, or maybe you for some crypto. I don't know. And that's the role that bonds have played. Right. Yeah. I think the role that the bond market is now playing is to be the fiscal kind of disciplinarian on, certain governments around the world. And, the bond vigilantes, I think the bond vigilantes are back. I think they need to be back. And I think there's going to be this game of tug and war, cat and mouse, call it what you will, between governments and between the bond markets. And I don't care who you are. No single person or single entity is bigger than the bond market. Not even you, Bilal.
Listen, I got a lot of personality, but I'm not. And it's funny you say that, because we've had a few conversations recently on the pod, and we talked about this.
Yeah.
More so because the Fed actually follows the bond market, to your point.
Yeah.
Right? They presume it's presumed that they lead.
Yeah, that's the dirty secret, right?
That's the dirty secret.
Jeffrey Gunlock once said they should shut down the Fed, and that they should just make the overnight rate equal to the 2-year rate and be done. And I'm like,
Kind of makes sense.
Yeah, kind of like, I'm like, Gunlock's a smart guy.
Yeah, exactly.
He's been doing this
he let the cat out the bag with that one.
Yeah,
though,
he
right?
did. And then you sort of start to think about it. And I felt sorry. Anyway, I interrupted.
Yeah, no, it's fantastic. So in your opinion, like, how should people think about a strategic allocation to fixed income? And here's the reason for the question.
Yeah.
You have a significant group of people who are retiring who cannot stomach equity risk.
Yeah.
And they may not be ready to tolerate commodity risk. So fixed income is still a viable component of what they hold. How do you look at that, and why active should be the key theme within holding fixed income?
So let me look. There's no alchemy that I can
You don't have one?
I haven't figured out this magical alchemy machine yet. And I think so. It's always best to distill in truth.
Yeah.
And the truth is that fixed income allocations aren't going to be as beneficial as they have been in the past, or what people have gotten used
just
to.
A math problem.
It's a math problem. And now with where we are with fiscal deficits, it's hard to see interest rates going back down to where they were 5 years ago. I mean, they were basically 0 5 years ago. And the problem is you had a lot of investors, a lot of retirees, a lot of everyday investors and savers that would open up their statements, look at their 401k, and they would look at how their bonds have done, and the bonds had not only provided income and coupon, they'd provided a lot of total return, right? Because interest rates had come down, and so you'd had that kind of double benefit. I don't think you're going to get that double benefit anymore. You'll get the income. Now, look, the good news is you've got a higher sort of starting point of income.
Yeah.
But in a world where you have deficits of 6 to 7%, I believe that the inflation risk is firmly to the right tail, meaning higher. It's going to be it's going to just be a tougher slog for bonds to contribute as meaningfully on a real, meaning after inflation basis. So look, they can go to other areas. You can go to higher yielding areas, and depending on what your income needs are, obviously high yield or loans. I mean, you can even get exposure to private credit in ETFs. That's something that may be a whole different podcast.
That's a whole loaded question.
That's a whole different podcast. But like, there are other ways that if you work with a financial professional, they can help navigate you through some of these fears. What I would say is, the way we're investing in fixed income now, meaning as an industry or a market, is changing.
Yeah.
It used to be, if I'd been here like a few years ago and we'd been talking, you'd have said, look, mutual funds and ETFs, it's pretty safe. Like, that's going to stay the fact. But oh my goodness, that statement would not have aged well if we had said it, that the active ETF is becoming the preferred vehicle for investors to get exposure to the markets. And there's now obviously a lot of choice around that. But again, I think fee per unit of, risk saved or alpha generated is pretty strong in fixed income. We haven't had a credit cycle really for 17 years.
Yeah.
Did I do my math right? Yeah, 2008 to now, about 17 years. It's close enough. And we've had higher interest rates for now 2 or 3 years. They're long and variable lags. I still think there's, a lot of risk within fixed income that you want a professional to be able to go out and effectively, if you're taking $100 of your money and investing it in the fixed income markets, you're lending that money to governments, to entities, to corporations. It's effectively what you're doing. If you just do it blindly in an index, no one's underwriting your loan.
Yeah.
That, just from a first principles perspective, makes me a little bit nervous.
Right.
And then in the opposite from equities, if you invest in equities and indices and market cap indices, they reward good companies that are growing. They become bigger. The more debt you issue, the bigger you become in indices. So not only are you not undoing any underwriting, you're structurally lending more money to the more indebted issuers, which, 101 from a bank credit department, probably not the wisest strategy. So I sort of think the rate cycle is going to be very different from what we've experienced. Starting rates are very different, and we haven't had a credit cycle in 17 or so years. And I think the fees now in fixed income for fixed income active are pretty attractive for what you get. And so that would definitely be an area where I would say it makes more sense to be active than index or passive.
I appreciate your views on that. So we've come to a part of the show where I like to ask our ETF issuers, what's one underdog in your portfolio of managers or ETFs that you offer that people don't know about, that you wish they had more visibility into, or that they knew was available to them in the market?
Underdog. All right. So I'm going to go with EBIT. EBIT.
Okay.
It is our small cap earners ETF.
Okay.
So I talked about being underweight small cap earlier, but there being areas of the market that we like. There's a dynamic in small cap is almost like two asset classes now. There's profitable small cap and there's unprofitable small cap. And if you look at the Russell 2000, which is the common sort of best, the common benchmark for small cap investors, I think it's about 40% of the Russell 2000 don't generate any profits. And if you look at it by market cap, I think it's like 27% or something like that, give or take a percent or two. And we think that's an area of the market that you want to avoid. And so last year we created an ETF called the Small Cap Earners Index, EBIT, as in, the measure of profitability.
Sure.
And it focuses on screening out the structural loss makers in the index. It's designed to be very well diversified. It's designed to give, broad-based sectorial exposure, but it's just eliminating that tail of offenders, of those serial offenders, by looking back over 3 years and really trying to give an effective way of exposure to the piece of the asset class that we think is most investable. And look, we're underweight small cap today. Small cap is not dead.
Yeah, but if I'm going to invest in a small cap, I'd like to invest in a company that's somewhat profitable or has the potential to be profitable.
Yeah, exactly. And actually, if you look at the fundamentals, if you break apart small cap and then you look at how profitable the profitable section is and how profitable the profitable companies are growing, it looks like a completely different asset class.
Yeah.
And so we sort of talk about this being the piece of the asset class that you wish you owned, that actually you used to own. Because this unprofitable thing or dynamic in small cap, it's more recent, meaning in the last 5-7 years. And kind of as the number of unprofitable small cap companies has grown, you've seen the risk premia associated with small cap go negative. And so it's kind of like, okay, let's get back to like fundamentals and 101. Can we provide our clients and our portfolios exposure to the piece of small cap that we should all own as part of a diversified portfolio?
I love it. Kristof, thank you so much for joining ETF Central.
That was fun, Bilal. Thank you very much for having me. And it was great to see you again.
Good to see you too.
Cheers.